Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk. I hope you like my new office. Today I want to give you some idea about how to keep as much as you can of your investing profits and income. This involves looking at the tax table. I know. Before you fall asleep, remember it's the money you keep, not the money you make. And so we want to be aware of how Canadians, I'll use BC as an example, and various types of income are taxed. Perhaps you'll pick up on a couple of things about our tax system you can use to your investing advantage. Please watch to the end of the video for a fun investor's tax tip that many people don't know about. Let's have a look at the 2020 tax table from taxtips.ca. It is a marginal tax table. It shows the tax rate you pay on an additional dollar of income when you are already making the money to be in that tax bracket. So if you're already making $50,000 and you make one more dollar of salary, you pay 28.2 cents tax on that dollar. It's not 28.2% on all of your income. Let's take a look at the first column. Salary, wages, RSP purchase write-offs and redemptions, interest made and interest write-offs, bond interest in a non-registered cash account, and non-registered foreign company dividends get taxed here. For that last item, for example, dividends that Microsoft, headquartered in the US, pays get taxed heavily in this column. Everything else not specifically in the other columns is taxed here. Let's take a look at the second column. Capital gains are taxed in this column, which is always half of the first column. This is when you sell anything taxable, stocks, bonds, investment real estate, gold coins, for more than what you paid for it. You pay taxes here on the difference in price between sell and buy. Non-registered trading accounts gains in price would be taxed here. The location of the stock or real estate doesn't matter. Capital gains from all over the world are taxed in this column. The third column is for eligible Canadian dividends. In BC, until about $150,000 worth of income, this is the holy grail of taxation. After $150,000, capital gains become less taxed. Other provinces differ because of the provincial taxes. Eligible companies are Canadian companies headquartered and publicly traded on Canadian stock exchanges, and they pay dividends. This produces the home bias that investing experts complain about in Canadians, but are just caused by our tax tables. And finally, in the fourth column, you'll find taxation for non-eligible Canadian companies, which are companies that aren't publicly traded or are personal corporations, such as when somebody is self-employed, incorporated for their business, and pays themselves dividends instead of salary. Those dividends are taxed here. This is still taxed preferentially compared to salary or wages. Firstly, you'll note that anyone who works for a living making salary or wages, or is a saver rather than an investor, is getting killed with taxes. Depending on how much of a conspiracy theorist you are, you can look at this in multiple ways. Either the rich make the rules, and since they don't work for a living, and the government made the taxes favorable for the investors and entrepreneurs. Alternately, the investors and business owners take risks, and the latter provide jobs to other people, and so deserve to be rewarded and get a tax break. Here are some conclusions to draw from the Canadian BC tax table. You want to be an investor rather than a worker or a saver. You want to buy things and sell them for more than you bought them for. If you want to pay less taxes, rather than collecting interest in a savings account and getting taxed in the first column, get a trading account and pay capital gains in the second column, or get taxed on dividends in the third or fourth columns. The non-registered cash account, especially if you exhausted registered accounts, or have Canadian companies that are eligible and pay Canadian dividends, can be a tax-efficient way to hold Canadian assets and collect Canadian dividends. And there are tax-efficient mutual funds as well. RSPs tend to be a default account, but if you buy Canadian eligible stock and hold it for years while it pays a dividend, it might rival an RSP for its tax benefits. This is because while you don't get the tax write-off up front, which is powerful because of its time value, In a non-registered account, you collect virtually tax-free dividends. Since you don't sell the stock, it is tax deferred just like the RSP, and when you sell it, you pay capital gains tax favorably only on the price appreciation, while the RSP hits you hard in the first column with its full amount that you withdrew. If you have bonds, not to say that you should, have them in a TFSA or an RSP, never in a non-registered account. Why is that? The bonds pay interest, which is taxed in the first column, so non-registered taxes them heavily as soon as you get the interest. The TFSA won't tax them at all. The RSP will keep the earned interest in the account tax deferred, and when you withdraw the money from the RSP, it doesn't matter what type of income it was in the RSP. It all comes out as fully taxable in column 1, just as the bond interest would. So there's no difference in tax treatment between RSPs and non-registered account bonds. Conversely, holding Canadian companies, especially if they pay eligible dividends, in an RSP may be a bit of waste of RSP contribution room, since RSP withdrawals get taxed fully in column 1 when withdrawn, rather than in column 2 or 3 as the Canadian companies would, and their dividends. RSPs can be used to hold mortgages as well, for example. So if you want to go in that direction, you can save RSP room that way and use it for other purposes. A quick word about borrowing to invest. Not that you should. If you buy Canadian stocks and you get eligible Canadian dividends and pay next to no tax in column 4, but you write off the loan interest in the first column, you can do quite well. Keep in mind that depending on your tax bracket, the tax write-off in the interest can be 20 to 30% on the average, which is significant, and this helps the dividends carry your loan's interest quite easily. And now what you've all been waiting for. Here's the bonus tax tip. If you are happy to get a tax refund after filing your taxes, it's great from a cash flow perspective. But keep in mind that the total amount of tax you ultimately have to pay is the same whether you get a refund or you owe money. If you are getting a refund, however, all you did was give the government an interest-free loan for close to a year until you get the tax refund in April the following year. Why would you get a tax refund, you may ask? Well, your payroll department is withholding taxes according to the information they know. If they withhold too much because you are buying RSPs through your bank, for example, you can still use a T1213 form, link is in the description, to get a payroll to recognize other RSP investments or tax write-off like childcare expenses, support payments, carrying charges and interest expenses on investment loans, etc., and withhold less taxes from your paycheck. And you get to use that money throughout the year. Fill out the form, send it to the CRA with the proof of the expenses, and the CRA will send you a letter with instructions to your payroll department to withhold less money from your paycheck. Just give it to the payroll department, and that's it. You'll get less money withheld, you get to use it, and then you don't get a refund and you're not giving an interest-free loan to the government. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Otherwise, please like, subscribe, ring the notification bell, and may you have a profitable day.